So what's going on with interest rates? It's the middle of March and there's a whole lot of stuff going on economically in the world. There's some global shortages now of oil with a war going on in the Middle East and a whole lot of uncertainty. And we've got a lot of borrowers who are starting to just be a little bit concerned about where rates are going. So thought I'd just run through a couple of the factors that are impacting things at the moment and give you a bit of an understanding of what our thoughts are. So firstly, yes, we do have a higher cost at the moment of some of our offshore imports. So things like oil, which is essentially petrol, is definitely getting more expensive. What that is doing potentially could flow through into increasing our inflation figures. And what kind of generally happens when that occurs is that the Reserve Bank starts to look at, well, how can we reduce that inflationary pressure? Can we put up interest rates? Now, I think in this context, they are going to be quite careful about taking any sort of strong, decisive action in that direction. For the last couple of years, our economy has been quite sluggish. We've had a couple of quarters of negative growth, and essentially that's put us into a recession. So we haven't really seen any big growth quarters for quite some time. So I think they'll be very mindful of taking too quick action there and increasing rates. What is really impactful though is the wholesale or the swap rates, which are the rates that the banks actually pay for the cost of their money that they buy in to then sell to us essentially in borrowing or in lending. And that rate has actually increased significantly, which is one of the main factors that is impacting the midterm rates. So 2, 3, 4, 5 years, that's where that swap rate becomes really important because they are factoring in essentially a risk factor. They're saying, we think rates are potentially going to increase, therefore we have to charge you accordingly. Otherwise, if too many borrowers fix for 5 years and it becomes cheaper than the standard cost of borrowing, then we're going to lose out. We're not going to make any money. So at the moment, that's possibly what is actually impacting some of those rebalancing of the mid and long term interest rates. The shorter term interest rates, the fixed for a year, even up to 2 years, but the 6 month and the floating rate, they are all generally much more affected by the OCR, the official cash rate. And at the moment that's been held. So in February it was held. It's likely to possibly be held again because there's a bit of uncertainty out there in the general economy at the moment, but we may start to see that OCR move up towards the middle to end of next year. I think that is probably looking a little bit more likely, but it also is really important to figure out what's best for you and your situation. So if you need some certainty in your situation, you want to know what you're going to pay, you want to know that your rate's not going to be jumping up significantly in the next couple of years, then a 2 or a 3 year rate is probably a good option for you. You're going to have certainty of repayments. It's going to be a little bit more expensive than the short-term 1 year fixed rate or even 6 months, but it is going to give you some real consistency of repayments and cost over that period of time. And a lot of people are currently opting for that, particularly people who ended up paying 6 and 7% in the last couple of years, which obviously did put a bit of pressure on budgets. So that's a really good idea. We are also seeing a lot of splitting of loans, looking for some certainty in the long term, but perhaps in the midterm or the short term, looking for flexibility. This is great if you are thinking you might have a change in role, you might have an increase in income, you might be selling a property, moving, anything that might affect either your ability to pay more on your loan or on your ability to pay off lump sums. Now, every bank has a structure on this. They have a policy around how much you can pay without penalty, how much you can increase your repayments, those sorts of things. So talk to your advisor about how that fits for you and your situation. Broadly, I think rates are probably still going to continue to be relatively stable in that sort of short to mid-term space. So between 1 and 3 years, I think will stay reasonably stable. We could see that that curve up to 5 years start to blow out. And I think that's really just pricing in some uncertainty and risk in the market, particularly around the cost of borrowing for banks. So the moral of the story is to not panic. There's a lot going on in the media at the moment. There's a lot of banks that are looking to put their rates up. We've seen some increases between 3, 4 and 5 years for most of the major banks this week, which is starting to kind of make people feel a little uncertain about where their future is. But my advice is to make sure that you have the certainty that you want, but also the flexibility that you need. So have a chat to your advisor about how that looks for you. You can book in a call below and have a yarn, and then we can make sure that things are set up for you and your situation. Talk soon.